Hi, it's Carl Allen. Welcome back to Dealmaker Empire. We are on module number 2, lesson 4, a very, very important lesson. So today we pull together the first 3 lessons and we create your perfect deal specification. And all this is relevant to all 3 types of deals: buying competitors, partners, suppliers, or even customers in your supply chain, or even complementary businesses so you can enter a new market segment. And whether you're going to make an acquisition, merge with another business, execute a roll-up of multiple smaller businesses, or build a portfolio of related businesses, you need a deal specification. So here's how we're going to do it. Now, first, we will look at the strategic vision and all of the intangible things that you desire, the cross-selling customer segments, the major areas of cost savings, where acquisitions can counter threats in your current business, exploit opportunities, or strengthen parts of your business that are currently weak. We will also look at location, sales channels, and key skills gaps that you have in your business that an acquisition can fill. And all these elements become filters for every deal you look at starting next week in the deal origination training. And the second part of the deal specification is to look at your wealth creation plan. And this determines the amount of deals that you need to do and over what period of time to hit your magic number, the amount of money that you want to generate when you've built your empire and then you sell it. Now, this tool works all of that out for you. So let's get to it. So here's the output from today's session. It's your deal specification one sheet. And this is your implementation work for this week. To populate this one sheet, which will become your mission statement and your lens through which every business you encounter will be measured. So print it out, stick it on your wall, print another copy, have it with you at all times. Think of it as your deal-making GPS. And it's okay to refine this as you move through the rest of this system. Create it now, then after you see some deals, you may want to refine it. You may see things in the market as you look at deals that may change your thinking in some way. Your financial goals may increase. They may even decrease. There's no right or wrong answer. So give this your very best shot as you see things today and then refine it over time if required. So let's go through it line by line. I'll walk you through the sheet, then give you a really good example. Everything in yellow is for you to populate. So start with your current information, your name, the name of your business, and the number of employees that you have today, your last full year of revenues and profits. Ideally, use your EBITDA, your operating profit. Much more on that in module number 5, the financial and deal structuring module. If you instead have SDE, seller's discretionary earnings, or even your annual free cash flow, you can use that instead as a proxy. Now, your annual profit margin is calculated for you. Then list the primary sector that you currently operate in, but be specific. If you own an engineering business, what does it do? Be really specific. And then you can list the primary targets or targets of sectors to acquire in. If you're buying competitors or supply chain partners, the target sector will be the same or similar to the current. However, if you want to acquire in complementary markets, this is where you list them at both a primary sector level and also the subsectors. So if you're in the automotive engineering, the subsectors could be leveraging that capability into, say, aerospace or marine and even agriculture. Then leverage your SWOT analysis. What weaknesses did you uncover that an acquisition will fix? What opportunities do you face that you can exploit much faster through an acquisition that either does that already or is geared up for it? Are there threats to your market position and your business in general? If so, what are they? Potential acquisitions can counter those threats. Next, list the target product and or service categories that you want to acquire into your business. Products and services your customers need, they buy from elsewhere, or they don't buy currently that you don't provide and don't want to develop internally. And it's the same with target customer segments. Look at this both in terms of sector, subsector, and also size. and you may only serve small businesses right now, and you want to target the government or larger customers, and an acquisition may do that for you. Next, look at your channels to market. If you only sell online or offline or direct versus going to market through affiliates or distribution partners, can you scale by going multi-channel? If so, an acquisition will do that for you. Also, look at the key people gaps that you may want to fill through an acquisition. Remember, acquiring another business doesn't just give you additional products, services, and customers, it also gives you more people, and these people can have skills that you don't currently have. The obvious one is a GM or a COO to run the combined operation for you if that's what you want. You may need a senior financial person, a CFO, FD, or even a financial controller. There may be other financial resources that you need but you don't have, like accounts receivable collections, or a tax planner, or a cost accountant. You may need legal and HR support. Sales and marketing is also a major category to add bench strength, especially if you're primarily an online business and you want to move into offline as a new channel to market. So you will need a marketer and a salesperson, perhaps a new business person, and also an account manager. You get to decide. And there may be other resources that you currently don't have that an acquisition can bring you. And then finally, look at geography. If you only operate regionally, do you want to use acquisitions to double down in that region or expand nationally, even internationally? The sky's the limit. You get to choose, and now is the time to think about it and lay it down, get it into the deal specification. Now you have the strategic side of the one sheet figured out. It's now time to look at the numbers. This is your wealth creation plan. And again, everything in yellow you need to populate. The white cells are calculated for you. So start with just two numbers. How many years do you want to build your empire? And more importantly, what's your magic number? How much money do you want to generate at that future date when you sell your empire as an entity much bigger than it is today? So next, we all have to pay tax. So enter your effective tax rate. I would stick with 30% to be conservative. If you're in the UK, capital gains tax on the selling of shares of a business is only 10%, up to £10 million as a lifetime number. If you sell your assets, the tax is higher. In the United States, the tax code is much more complicated. So check with your CPA or your tax advisor on a likely tax percentage upon the sale of an empire at the numbers that you specify. And once you have a tax rate, it grosses up your exit number to the amount that needs to be generated by the sale. Next, we need to translate that number back to profit, EBITDA again. And for what we use as a profit multiple, I get into this more in Module 5, but you know businesses are typically worth a multiple of profit. Now, I recommend you use a 5 times multiple at this stage. You may well end up selling for a much higher multiple, and remember, the bigger the profit, the higher the multiple. It compounds. 5x is a sensible multiple to be used at this planning stage. Now you know the total amount of EBITDA that your empire needs to generate at the time that you want to cash out. Then we extract the EBITDA that you currently generate to work out the EBITDA gap, the increase in profit needed over the time period. Now this increase will come from 4 places. It will come from normal organic growth. 10% is a conservative estimate for this. You'll also generate additional profits from cross-selling and the financial deal synergies that we discussed in earlier lessons. And I typically use 20% each for these, which leaves 50% of the EBITDA profit gap coming from those target acquisitions. So next, input the average profit margin for your sectors or blend it across the sectors that you're targeting. You may just use the margin that you currently have in your own business, or you may want to increase it or decrease it. You will know if your margins are higher or average or lower at a par. Now we know the total revenues required of the target businesses that you need to buy. This could be one acquisition or could be several. It's more likely to be higher than one. And then stated average revenue for a target business. Remember the $1 to $10 million range, and you now know the number of deals required to hit your exit number over that defined time period. So let's go through an example to bring this to life. So this is for John Smith. He's the owner of ABC Engineering LLC. He's in the USA and he's based in Georgia. So John has 14 employees and is currently generating $2.5 million of revenues and $315,000 of profit, which is a 13% profit margin. He's in the automotive sector and he engineers components for performance sports cars. That's a sector he wants to double down on as his market share is really tiny. However, these components can also work in parts of the aerospace, marine and agricultural sectors. So leveraging his SWOT analysis, John's biggest weakness, he does little to no marketing or new business development. All of his customers are repeat and new customers come from word of mouth referrals. He wants to fix this through an acquisition by acquiring a business that is strong on marketing and sales. There's big opportunities in multiple target sectors to attend trade shows. One threat John is facing is that some of his customers are starting to manufacture the components they buy from John internally. So he needs to diversify and add new customers to his business. And he primarily manufactures injection systems, but he wants to also get into manufacturing gears and valve components. And all of his customers need these components as well, but John is not tooled up to do that himself. Hence the acquisition of a business that already does it. John also sees a big opportunity as a service to retrofit components. Again, he doesn't want to build that internally, and that's another potential acquisition. And he only deals with small to mid-sized businesses, and he wants to double down there as well. And he also wants to get into larger accounts, both in the automotive sectors, as well as defense contractors and original equipment manufacturers, or OEMs, which are the supply chain partners between John and the ultimate customer, the car company or the tractor company or the aerospace company. So today, John is primarily selling direct to the customer or through channel partners, but he also sees a big play online selling his components to the collectible car market, the hot rods. He has some people gaps to fill. He wants a GM or a COO to run the group so he can work on the business rather than in the business, which is what he does today. He has a part-time CFO, his CPA. He doesn't need other financial, legal or HR personnel, but he desperately needs sales and marketing chops. He's done a bad job trying to hire those people before. Acquiring a business that has some is a great solution to this problem. And he also wants a partner manager to manage his supply chain more effectively and generate more internal business. So John's based in Georgia and he's exclusively East Coast. He's open to national presence, but not interested in building a global empire. There's more than enough business for him to exploit inside of the USA and potentially Canada. So now let's look at John's wealth creation plan. He wants to retire in 5 years. He's 45 now and he wants to cash out at 50. Nice! And his number is $5 million. So using a 30% effective tax rate, that grosses up his selling payday to $7.1 million. He will pay tax, then still net that $5 million that he needs for the rest of his life. That's his magic number. So John's forecasting a 5x selling multiple, so the total EBITDA that his business group needs to generate in 5 years is then $7.1 million divided by the 5x multiple, which is $1.4 million and change. Now, his current profit is $315,000. So the gap, the extra profit he needs to generate by the end of 5 years is $1.1 million. It's the total less his current number. Next, let's look at where that gap closure is going to come from. Now, John's assuming 10% will come from organic growth, 20% will come from cross-selling, and 20% from all of the financial deal synergies that his acquisitions will generate. all from the activities that we discussed in lesson 3 of this module. So that leaves 50% of the gap for acquisitions to target now. That's $556,000 of EBITDA profit that John needs to acquire. And he's blended his industry profit margin at 15%, just a touch higher than his own 13%. So dividing that into the profit gives him the approximate total revenue that he needs to generate through the businesses he buys now. That's $3.7 million and change. That could be one deal or it could be several. Assume that John's average target deal size is $1.5 million in revenues. That would mean essentially 3 deals to hit the big magic $5 million number after tax in 5 years, all assumptions accepted. And that's the deal specification. It combines your strategic vision with your financial requirements. And that's it for lesson number 4. And next up is the implementation lesson, where I'll recap the major items of module 2 and set your assignment for this week. And I will see you there. Until then, bye for now.